If you claim Social Security before reaching that exact month of your full retirement age, your benefit was permanently reduced for every month you filed early. On a monthly benefit of $2,000, claiming just 6 months ahead of schedule can reduce your payment by roughly $60 every month for the rest of your life. Spread that across 20 years of retirement, and that 6-month decision can cost you approximately $14,400 in total benefits. That is a significant loss caused by a timing issue many people never fully understood. This age group is also dealing with the earnings test in 2026 if they claim benefits before reaching full retirement age and continue to work. This year, the earnings limit is $24,480. For every $2 earned above that amount, the Social Security Administration withholds $1 from your benefit payment. Many people see those withheld payments and assume the money is gone forever. That is not what actually happens. Once you reach full retirement age, Social Security recalculates your benefit and gives you credit for the months during which payments were withheld. As a result, your future monthly benefit increases permanently. The earnings test is essentially a delay in payment, not a permanent penalty. However, if nobody explains that process, the missing checks can certainly feel like a financial loss. For those who have not claimed benefits yet, it is important to understand the value of waiting. Every month you delay claiming after reaching full retirement age increases your benefit by roughly 0.2%. Over the 3 years between full retirement age and age 70, that adds up to a permanent 24% increase. On a $2,000 monthly benefit, that means approximately $480 more every month for the rest of your life. Because future cost of living adjustments are calculated as a percentage of your benefit amount, a higher starting benefit also means larger COLA increases in dollar terms throughout retirement. For Americans born between 1960 and 1965, you're currently between 61 and 66 years old. Your full retirement age is now officially 67. This marks the completion of a gradual change that began decades ago, and 2026 is a year that transition is fully locked in. Under current law, no additional increases beyond age 67 are scheduled. What this means for your generation is that the reduction for claiming early is now at its maximum level. If you claim benefits at age 62 while your full retirement age is 67, your monthly payment is permanently reduced by 30%. Using a $2,000 monthly benefit as an example, that translates into $600 less every month for the remainder of your life. Over 20 years of retirement, compared with waiting until age 67, that difference adds up to roughly $144,000 in lost income. Compared with waiting until age 70, the gap can exceed $259,000. The Social Security Administration will process an early claim without presenting those numbers in simple dollar terms. You will be asked whether you understand that your benefit will be reduced. If you agree and move forward, the application is processed and the lower amount becomes your permanent benefit baseline. There is another option that many people in this age group never hear about. If you're already past your full retirement age of 67 and have not yet applied for Social Security, you may be eligible to request up to 6 months of retroactive benefits when you file. For someone receiving an average monthly benefit, 6 months of retroactive payments can amount to more than $12,000 paid as a lump sum at the first check. There's a trade-off, however. Taking retroactive benefits moves your official claiming date backward, which slightly lowers your ongoing monthly benefit. Whether that trade-off is worthwhile depends entirely on your personal circumstances. The important point is that the option exists, and many people never learn about it because they do not specifically ask. If you were born in 1963, 1964, or 1965 and are currently between ages 61 and 63, there's another opportunity available right now. A retirement savings window is open, but it closes once you reach age 64. The Secure 2.0 Act created what is known as the Super Catch-up Contribution for workers between ages 60 and 63. In 2026, eligible workers can contribute as much as $35,750 to a 401k, compared with $32,500 for most workers over age 50. 3 years of contributions at that higher level can generate more than $100,000 in additional tax-advantaged retirement savings before the opportunity expires. If you are 61, 62, or 63 and still employed, check with your Human Resources Department to confirm that your plan allows super catch-up contributions and take full advantage of the limit if possible. For people in this age range who are still several years away from claiming Social Security, one of the most valuable actions you can take today is reviewing your earnings record on the Social Security website. Open your Social Security statement and compare each year's earnings against your own W-2 forms or tax returns. Every year that contains an error, a lower income figure than you actually earned, or a year incorrectly listed as zero, can permanently reduce your future benefit. In many cases, each incorrect year can lower retirement benefits by approximately $100 per month. Finding and correcting those mistakes while records are still available can have a substantial impact on your future income. Now, let's talk about people born in 1966 or later. If you fall into this category, you are currently age 60 or younger. Your full retirement age is 67. Claiming benefits at age 62 still results in a permanent 30% reduction. Waiting until age 70 can increase benefits by up to 24% above your full retirement amount. Those rules are already established for your generation. What deserves your attention today falls into three important areas. The first is the super catch-up contribution opportunity. If you turned 60 during 2026 and were born in 1966, you now qualify for the enhanced 401k contribution limit of $35,750. Take advantage of it if you can. You have 4 years, from ages 60 through 63, to maximize contributions before the window closes. If you are younger than 60, that opportunity is still ahead of you. Make note of it now and begin preparing your finances so you can contribute the maximum amount once you become eligible. The second area is your earnings record. The Social Security Administration has been collecting payroll information from employers since your first job. Throughout that process, mistakes can occur. Earnings can be reported incorrectly, years can be omitted, or self-employment income may not be properly recorded. For people who worked during the 1980s, 1990s, and early 2000s, when payroll systems were often less consistent than they are today, there's a meaningful chance that at least 1 year in the record may not accurately reflect actual earnings. Every incorrect year can reduce future benefits by roughly $100 per month. Log into your Social Security account, review your statement carefully, and compare the information against whatever employment or tax records you still have available. Correcting errors today is much easier than trying to locate supporting documentation 15 years from now. The third issue is the Social Security Trust Fund. In February 2026, the Congressional Budget Office moved its projected depletion date for the Social Security Trust Fund forward by 1 year, placing it in 2032. That is only 6 years away. If lawmakers do not make changes before that date, Social Security would only be able to pay approximately 77 cents for every dollar of scheduled benefits using incoming payroll tax revenue alone. That would represent an automatic reduction of about 23% across all benefits. For younger workers who have not yet retired and expect Social Security to be a significant part of their retirement income, this represents one of the most important long-term financial issues to monitor. It does not mean Social Security is disappearing. What it means is that staying informed matters. The people who pay attention to developments have the most to gain, while those who assume everything will work itself out may face unpleasant surprises later. So here's the overall takeaway. If you were born between 1943 and 1954, review your survivor benefits. Confirm that any WEP or GPO-related adjustments have been applied correctly and determine whether any IRMA surcharges might be subject to appeal. If you were born between 1955 and 1959, know your exact full retirement age down to the month. Understand how the earnings test works and calculate the value of delayed retirement credits before making a claiming decision. If you were born between 1960 and 1965, fully understand what a 30% permanent reduction means in actual dollars. Ask about retroactive lump sum payments if you're already past age 67 and have not yet filed, and review your earnings history while corrections are still possible. And if you were born in 1966 or later, take advantage of the super catch-up contribution opportunity if you are between ages 60 and 63. Verify your earnings record while documentation is still available, and stay informed about developments affecting the Social Security Trust Fund. Subscribe to the Frank American and share this information with friends or family members who fall into one of these age groups. A few minutes of planning today could make a substantial difference in retirement income tomorrow.